We just got the latest CPI print, and it shows inflation hotter than expected. So, what could we expect next from the Fed as a result, and where's that going to move the housing market? Let's get to the bottom line. Good morning. Interest rates just moved higher from the 6.75% average we were seeing to 6.81%. So that puts us roughly 3.6% higher than the same time last year. Now, this marks 7 straight weeks of increases in the average rate. And a reminder, we use the MBA, Mortgage Bankers Association, weekly survey to provide this average for interest rates. When it comes to purchase application volume, which is also through the MBA survey, we saw application volume for purchases falling by 2.1% week over week, and that puts us down 39% for purchase applications year over year. So continuation of the same trends, and speaking of continuing trends, inflation has been a trend of this entire video series because inflation has been a huge topic of conversation for the economy in 2022. We've got new data, so let's jump into it. We just got the latest report for CPI, the Consumer Price Index for September. And this report shows us that overall inflation increased by 0.4%, which was double the amount that was expected. This actually puts the year-over-year headline inflation number in a decline from 8.3% to 8.2%, but it was expected to decline to 8.1%. So across the board, higher than expected inflation readings on the headline. And the real story here is the core rate. The core rate strips out food and energy prices, which are volatile. So this is actually an area that the Fed pays close attention to, are these core readings. This increased by 0.6%. That was hotter than anticipated. And as a result, the year-over-year core inflation reading increased from 6.3% to 6.6%. So important data here because it shows us in the most recent readings that we have where things stand for inflation. But Jake, dive into this a little further because it's such a key topic when it comes to mortgage rates and therefore the housing market. So what are we seeing right now when it comes to inflation?
Yeah, of course. So getting into some of the specifics about the CPI report that just came out, we saw shelter rise by 0.7%, and that actually matches the highest increase since 1991. The other big component I want to dig into is rent. So we saw rents go up 0.8% month over month, and that puts them up 7.2% year over year. Another thing I wanted to talk about is what does the Fed kind of think about this most recent report? We don't necessarily know that, but from the comments in the most recent meeting, Loretta Mester spoke and she stated that she has not seen any progress on inflation. And she actually thinks that the Fed needs to continue to raise rates and be more restrictive. This is a total flip-flop from where this same individual stood on this subject last year. Last year, she said she wasn't concerned with inflation at all, actually said that we need more inflation. And this just goes to show you how complex this subject can be. You really do need to question where you're getting your information and make sure that they're not flip-flopping and changing direction. So keep this in mind when you're moving forward, when looking at where the market might go in the future.
Yeah, thanks, Jake. That's definitely an important piece to keep in mind. We really want to try to cut through a lot of the noise and information that's out there to try to boil it down to the most important data points and facts on what we're currently seeing. So definitely an important one to keep in mind there, and appreciate you going over that. You know, another big focus of the Fed and really anyone in the American economy is going to be our unemployment rate. And that has actually been something that has stayed fairly strong. We want to go over the latest data that we have in that area. Unemployment rate in the United States decreased back from 3.7% down to 3.5%. So this is an important metric because that's part of what the Fed is going to be looking at when making determinations of what they can do when it comes to rate increases. To give a little bit more context, the BLS reported 263,000 jobs created in September, which was above expectations. And interestingly, most of those gains came from those that were 45 and older. The separate measurement is a household survey, which shows 204,000 jobs created. And just one interesting note, when it comes to the unemployment rate, we're talking about, with this headline unemployment rate of 3.5%, the U3 unemployment rate. This is what most people look at, and this is mostly what you're going to see referred to in the media. This removes individuals who are not actively searching for a job. The U6 is the all-in unemployment rate, which is going to add back in those individuals that are excluded from the headline rate. So when you look at that U6, there's another roughly 5.8 million people who want a job but have not looked in the past 4 weeks. And so that rate is going to always be higher than the headline. This rate, though, also did decrease. It came down from 7% to 6.7%. So important to keep an eye on the unemployment rate, because with the unemployment rate low, that gives the Fed a green light to continue increasing rates and fighting inflation. And as Jake talked about, what they're seeing is no progress at this point on inflation. The concern we need to have is that it takes time for these rate increases and changes by the Fed to come into effect. It's kind of an antiquated system in some ways, where they're looking back at data from the past and deciding, what are we going to do for next changes moving forward? So they're kind of looking in the rearview mirror. So, with that in mind, you do have some people out there projecting that we may be nearing the peak of inflation. And part of that comes from the fact that we are actually replacing some of the higher inflation readings from late 2021. And when you have those tougher comparisons, that makes it easier for the numbers that are replacing them to potentially lower the inflation rate going forward as we near the end of this year. So, of course, we're going to want to keep a close eye on that, because inflation affects interest rates, and interest rates have been a driving factor in influencing the housing market. So for you housing professionals that are out there trying to stay informed on where things stand, we're going to bring you the latest news and data each week. We'll see you next week on The Bottom Line.